Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with Mawer's CIO, Paul Moroz, about the global balance strategy. We talk about building the portfolio brick by brick, our overall risk management approach, and highlight a few holdings, including discovering why a specialty chemical company's active ingredient in wrinkle cream is a competitive advantage.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Today with us is Paul Moroz. He's our Chief Investment Officer and Co-Manager Global Equity, and we wanted to have him on the podcast today to speak about maybe something that doesn't get as much airplay around more these days than maybe it should, is our global balance portfolio. So Paul, welcome to the podcast once again, reappearing.
Thanks for having me once again.
Okay, you're welcome. So Paul, before we get into specifics of the portfolio itself, why don't we give a little background on why we actually offer a global balanced portfolio to clients?
I think we have to go back a little bit further, even to when we started global equity. And the reason I say that is on the equity piece, a big part of global equity when that came about in 2009 was we had all the building blocks to change the way we thought about constructing portfolios. And the idea was that the world's really globalized, and in the past, in kind of the old world where the different stock markets and currencies were very much independent and you could allocate capital between countries, that sort of broke down and the world started being a lot more correlated. So in 2009, we started our global equity fund and global equity mandates that worked together to put a portfolio that was stitched brick by brick, so to speak, individually selected stocks. And the purpose of that was really to try to build the most resilient portfolio possible so that different themes and risks that work its way through the portfolio, if you ended up in that scenario, the portfolio was going to be okay. It would bounce back from that scenario. And that set up global equity, that same concept of the resilience, not only diversified, but having the securities work together so that they're resilient. They can bounce back from tough scenarios.
Okay, so what I'm hearing in that is maybe a definition of resilience is that there's a bounce back effect.
There's a bounce back. You get into the glue of some scenario that you can't necessarily predict. It may or may not happen, but when you do get into that scenario, the portfolio can bounce back. It continues to grow. What you don't want is that permanent impairment of capital. That's so important for clients to understand that we're working on. That's what the scenario we don't want. We want things to be resilient. Of course, we'll go through tough markets and tough economic times, but we need it to bounce back.
Now, you mentioned the start date of global equity was 2009. Has it had a test of resiliency?
Well, we've been in a very similar market regime since the start date. So the short answer is it hasn't been tested in that regard. Of course, all the other funds that we offer and mandates, you can go back and see how the securities performed. So we have a good sense of how we can do in a downturn, but that's where I spend a lot of my time focused on with global equity and ultimately global balance, is so that we will get tested eventually and making sure that it can bounce back.
Let's cover a little bit of how you actually go about. So you said brick by brick, but how do you go about building this global balance portfolio? Is there a bit of top down to it? What level of judgment is involved around the macro as opposed to the micro?
Well, remember, there's two components to global balanced. We have the equity sleeve, which typically represents about 60% of the portfolio. And then we have the fixed income sleeve, which is fixed income and cash component, which is in totals 40%. Included in that is an allocation to global bonds. And so the thinking, and this is really important for people to understand, that fixed income sleeve, that's about protecting capital, preserving capital. It acts as a fire extinguisher if there's a fire. So our game isn't to pick up pennies on the train track and trying to reach for yield and reach for credit with our fixed income portfolios. We want that to be really safe if there is an event, a particular scenario that's not so hot. So that's the first basic when you think about the construction of global balanced. And also along the lines of different scenarios, there's certainly a scenario where the Canadian economy and the Canadian dollar doesn't perform well. And you can envision what happened if we were in a scenario of a banking crisis, and how do Canadian bonds and the Canadian dollar work in that scenario? So that's one of the reasons we have a sleeve of global bonds in there to help protect that particular environment. Now, within the equity sleeve, the question is, well, how is that put together? And we use a similar approach to our other funds, only there's an expanded universe. So we look at the quality of the securities across our platform, and then we look at the return potential. And we map that out on something we've called the matrix. And I think we may have spoken about this before in podcasts. I think the overlay and what we spend a lot of time thinking about is the risk management of it. So how do the individual securities fit together in terms of currency exposure? And how do they fit together in terms of the different company business models and the different country risks? Even where the securities are at within their economic cycle. So it's those aspects that we want to not only diversify, we call them the 4 C's, but then think about, well, what offsets do we have in the portfolio? And if we end up in these different scenarios, let's say interest rates rise, higher interest rates, well, is the portfolio still going to be diversified? What sort of offsets do we have? What securities are not performing well? And map out those scenarios.
It's a great description of how it's put together and the reasons why. And I think it's a good segue into your role as CIO. I would characterize it maybe as ultimate risk manager, or risk awareness officer. So let's get into talking about the current investment environment, what risks are out there. Do you use some kind of framework to rank risks?
If you think about the framework for looking at risk across our organization at Mawer, there's 4 building blocks. The first is actually at a cultural level, and I think listeners might be surprised how much focus we put on that. So actually making sure that our team gets along well and is a high-functioning team, shares different ideas, and is candid with each other. Because if that candor and communication breaks down, we're not going to get those opposing ideas and debate out in the open. And then there's the risk that we miss something if we don't have enough humility.
Can you give us an example?
Well, sure. Just recently, our summer student, Michael Song, came over to my desk and he was debating the merits of a Brazilian company, a company that I had just met with when I was on my trip in Brazil. Mm-hmm. And we were debating the merits of that. Now, he had some...
Wait a minute. It wasn't the company that chased you out of the store, was it?
No, it wasn't that company. It was a different company in Brazil. It was actually a travel agent company. But he had a different perspective or view on how their business model worked, a different interpretation. And that's really important for him, being a summer student, to be able to just walk over to the CIO's desk in our open office environment and share those opposing thoughts. Because he was right. There is a different interpretation of that, in this case, a very specific aspect of the business model that served as a risk. So my first point on how we think about risk, if our culture moves or adjusts such that we can't have those conversations, that's a big risk across our organization. But let's move up the next level of risk management, and that is really in how we select the securities. Are we following our investment process? So I think that most people are aware we're interested in excellent companies that are run by able and honest managers, and we don't pay too much. What you might not recognize as a listener is how much we focus on quality assurance. I'm not sure if this has been released on your podcast. We have something called the bathroom list.
Oh my God. What possibly could be the bathroom list related to investing? How do we do that?
Well, if you walk into a Starbucks and use the washroom, what you might see on the wall is a bathroom list, a list of when the toilets have been cleaned, when the sinks have been cleaned, what time they were cleaned, and who did the cleaning. And we have a very similar quality control checklist for the research. When's the last time that we've updated the model? When's the last time that we've interviewed the management team, rebuilt the report, talked to independent sources to understand the investment thesis? So we really try to run our research department at Mawer like a factory to make the highest quality investment decisions for our clients. So that's just an example of a process for how we manage that element of risk. If we move one step up further, we have portfolio construction. And this is really about, well, are we diversified? So this is important for the Global Balanced Fund because, and any fund across Mawer, the maximum weight in a portfolio is 6%. And you think about what that...
Weight of what? You didn't say what.
The weight of a security.
Single holding.
A single holding.
Gotcha.
That's correct.
Okay, thanks.
For if we own and we do Google, Alphabet in the portfolio, the maximum exposure we could have is 6%. So this ensures diversification. And if you think that the equity exposure is 60% of that, then it's really 3.6% maximum exposure in the Global Balanced. So there's that element of looking across by stock, by industry, country exposure. Then we get to the final stage, looking at systemic risks. Is the portfolio going to be resilient in different scenarios? And we're seeing different scenarios. We're seeing scenarios right now where it could be the case that the Federal Reserve continues to increase interest rates and the US dollar is very strong. And what happens then? What happens if there's a recession? How is the portfolio structured to deal with a recession? Are we going to be able to bounce back from that? What's the impact on emerging markets? If the US dollar is very strong, do you see a continued deterioration in emerging market currencies, such as the Turkish lira, such as the Brazilian real, and so on and so forth? How does the portfolio stand up in that environment? So the approach to risk management is not that we're trying to predict the future. I'm not getting on TV and calling where the price of gold is going to be. But what I do want to have happen is if we do land in that scenario, I want to be in a position where the portfolio can bounce back and that as we're sliding into it, we can kind of lean away. We can roll off the risk as the cards get turned up.
So at that top level right now, Paul, are there any scenarios that would have higher probability in your mind?
Well, I think the big one is what's going on with the US dollar and US interest rates and the impact on emerging markets. You have an economic environment that might parallel what was going on in maybe 1997, 1998, where liquidity is moving across the system. And I think that's probably the biggest systemic risk we have for investors and across the economies is the move on US dollars. So that's certainly the indicator of risk. What's the US dollar doing versus other emerging market economies? That's capturing a lot of risk. We're shooting this podcast today on a day where we just went risk off. So Turkish lira was down, Brazilian real down 2%, South African rand down 2%. That is absolutely top of mind.
The great fear out there right now is some kind of contagion of emerging markets. Takes all markets down.
Sometimes it shows up in the banking system because the banking system, and if we take Turkey as an example, maybe we had companies that were borrowing US dollars. And of course, as the lira depreciates, then they have more debt and a higher interest rate and so on. Sometimes it's more on the sovereign side. So in the case of Turkey, Turkey also has a fair amount of external foreign debt the government's borrowed. So that becomes an issue. Often when things break like this, you can have a recession. If we take Chile in 1982, the issue of what happened there is copper prices declined. You had a global recession because Volcker at the time was raising interest rates. You had a very similar phenomenon that spread into a banking crisis, and you had a number of bankruptcies that occurred in a severe recession. So the transfer mechanism that you're speaking of can go a number of different routes. I think the issue is that this is difficult, if not impossible, to predict. I actually don't know whether this is going to unfold into something like Chile in 1982 or Mexico in 1994. What we are trying to do is balance the odds in the global balanced portfolio such that, well, if we do go further down this path, we're still going to be okay. And if we don't, well, no, we can still make money in emerging markets. Emerging markets, by the way, still from a perhaps long-term opportunity point of view, represents some of the best value. Keeping in mind, as Keynes would say, in the long run, we're all dead. You have to put things in perspective. Let's go back to just for a moment. So what diversification, and when we talk about emerging markets exposure, we're looking at 8% exposure to emerging markets in the global equity portfolio. So within global balanced, that's 60% of that. So that's a manageable amount if we do get into that situation. And of course, there's building the portfolio brick by brick. There's elements of it that provide relief.
From a risk management point of view, within the global equity sleeve, what have you been doing? What's been going on? Give us maybe a primary exit that you feel was important to the portfolio.
A lot of the moves that we make are done probabilistically. As we see pieces of information come up, we shift, we adjust. As the Federal Reserve has begun to increase interest rates in the United States, recognizing where we are in the cycle, we began to decrease our position in BlackRock. BlackRock's an excellent company. They've very much a tax on the investment business across the United States, gaining share in passive investments. And we've done fantastic on the investments, and it's time to start to shift. And we have done that. We've decreased that position over time, and say just for time frame sake over the last 3 to 6 months. And we've recycled capital back into companies that might benefit from interest rates going up. So we've increased our position in AIA, which is largely a life insurance company based out of Hong Kong. And they have reinvestment risk in their policies. So as interest rates go up, assuming that it's a more gradual fashion, that the market doesn't go discontinuous, they're going to benefit from reinvesting capital back into those higher rates, and they'll make more money as you compare that to their claims, which stay static.
Another really topical bucket of stocks are the Fang stocks. So one, how much exposure is there within the portfolio to those? There's maybe in a day like today where it's risk off, those are the first ones that get sold. So how are we building resiliency through exposure or not in specific names like that?
We do have a little bit exposure to the Fangs. We own Google, and that's one of our larger positions. Google has a pretty strong network effect. And what we also like about the company, I think it's what people perhaps underappreciate about Google is the culture. And they've had a lot of success developing different business options. And those options might well be undervalued by the market longer term. I mean, they've had some fantastic success with YouTube and Android. And so a number of the things they're working on now could be quite big. So we still have some exposure there. Where we've trimmed is Tencent, which is a large internet technology company in China, which has some fantastic platforms. I mean, for Tencent, for a lot of people, is the internet in China.
Yeah, absolutely.
But they make most of their money through the monetization of video games. So it's still a fairly narrow business model. And they're making a lot of investments that are much longer term in nature. So the payoff could be 10 years, 20 years, 30 years down the road. And what we look at in a rising interest rate environment, the so-called duration of an investment like that is much longer. You don't get your money back for a very long period of time, and thus the investment is much more sensitive to a rise in interest rates. That was one of the reasons that we actually exited our position in Tencent. And the stock's actually a fair bit lower than when we exited the position.
Even though we're long-term investors, it sounds like with Tencent, there's a threshold of, if I have to wait 20 years for that cash flow payoff on Tencent, then I'm willing to put capital elsewhere.
Sure. It was the going through the discounted cash flow model with Tencent and looking at the scenarios. And I was in a meeting for, it must have been 3 hours with our analyst in Singapore, working through the different scenarios and saying, okay, well, if they monetize WePay, what's that worth? When can they gain that cash? If they can hold on to 30% of the advertising market in China and it grows something similar to what we've experienced in a more developed country, how much money do they make? When's the timing of that cash flow? What's the probability of success? When we discount that back, is it worth holding to security. At the time, we thought, you know what, we're just going to shift. We have other options.
You started the conversation and you keyed in on resiliency. So maybe we can talk about 3 of the top 10 names in the global equity portfolio, and you give us the reason behind each. That's a resilient holding.
Where do you want to start? Maybe Wolters Kluwer?
Sure. Let's go with Wolters Kluwer.
So this is a terribly boring business. I don't think most people will recognize it. I mean, they're involved.
But it's the art of boring.
It is the art of boring. So this is a publisher, really turn data and information company. They're involved in the terribly attractive businesses of accounting, tax, and healthcare. And they provide information. They used to, and still do, provide reference books for legal practitioners. One of the boring things they do is they provide health information on websites for doctors. Our president actually was out at his doctor getting checked up, and he's snooping over to this computer and is quizzing the doctor on what sort of program, and sure enough, it's Wolters Kluwer. So that's imagine that. Your doctor doesn't shut that off. Your doctor doesn't say, well, we're in a recession now. I'm not going to subscribe to this information and we're just going to guess what you have.
Yeah.
You know, this is a non-discretionary spend. So we're trying to find investments, make investments like that where the price we're paying for still makes sense, where that's pretty boring and that will be pretty resilient. So there's Wolters Kluwer.
Okay. Maybe a smaller cap name globally, but it is in the top 10 in the global equity portfolio, is Croda International. So why is that resilient? What do they do? What might be the risks?
So Croda, UK-based company, specialty chemicals company. They manufacture chemicals and have a direct sales force and work with the customers to innovate. A lot of that business is into a consumer segment. So they'll sell things such as an active ingredient that goes into anti-wrinkle cream.
Ooh, good one.
And they sell this to the cosmetic companies all around the world. So it's something that costs a very small amount, but the value proposition is very important for your anti-wrinkle cream to work.
There's anti-wrinkle cream and there's anti-wrinkle shirt fabric, isn't there? For Croda? They do that as well. Yeah. Okay, so that's Croda. How about the top holding, JP Morgan Chase? How is that resilient?
Well, JP Morgan is a leader in almost every division that they're in. They're very significant market share across mortgages, across their merchant credit card business. They're involved in ETFs. They are involved significantly in capital markets and fundraising. So that's just a company, especially given its heritage, has really done a good job and dominated. And I think Jamie Dimon, who runs the company, has talked a lot about building a fortress, making their balance sheet a fortress to protect against downturns. And that was certainly when they went through the financial crisis in 2008 and 2009, they were in a position to be able to allocate capital, and one of the companies that came out very strong. So they were able to bounce back, and that's really the definition of resilience.
I really like how we've concluded on 3 of the top 10 and explaining to folks why we focus on resilience. So I want to thank you for the conversation on the global balance portfolio. Maybe we can just close the conversation on asset mix. I know it's kind of an age-old question in our industry, is what mix is right in a balanced portfolio? Why is it 60-40, Paul?
When we've studied the asset mix in the past, and I think this is a good model to use, or a mental model, if you had absolutely no knowledge about a particular subject and you want to diversify, how would you come to a decision? And you'd probably divide that in equal parts. And so when we've back tested this without knowing what the future would look like or what changing historical returns, like we believe that one of the most resilient models is just to diversify across the different asset classes. From that perspective, bonds and equities would get an equal weight. Now, we've given equities slightly better than equal weight because historically equities have performed well. They have a higher discount rate embedded into them and have generated a lot of returns. And there's much more optionality in that asset class than there is bonds. So I think that's the reason why we've gravitated towards that structural asset mix, and why also that's a bit of embedded wisdom across the asset management industry.
Very insightful commentary. I think we'll leave it at that as far as global balance goes and shift to one more thought. And I've seen you in the hallway with a pannier and bike shoes on, so I want you to explain to people what that's all about.
Those panniers are going to fit on a bike rack that I helped strengthen. And one of the things I did, I bought this bike rack, I ship it off, I buy it from somewhere on Amazon, set it up, and I noticed that it looked a little bit weak. And there's one particular rod, the way that it was constructed, I was concerned that while I'm pedaling through the mountains, it's just going to fall apart. And then I got my tent and all my gear, and I was worried about that. So I strengthened that by cutting some aluminum tube, and I spent some time grinding it down, and I'm drilling out this aluminum tube, and
You got a whole machine shop at home or what?
My dad has every tool known to man.
Awesome.
If you need a tool, he'll have it. My point is I do all this engineering and create this, what I think is a wonderfully engineered addition to the bike rack. And my brother, who's an engineer, is looking at it, and he said, Paul, you might want to be careful because that might have created a point of stress where there's an issue. And I thought, well, maybe that there's a point of a stress on my bike rack or not, but it's just a good model for looking at investments, is looking across the portfolio, where could a point of stress be? And right now, it seems like it's the U.S. Federal Reserve raising interest rates, and we're starting to see that point of stress in emerging markets.
Okay, we'll end with that. Thanks for being here, Paul. That's a great way to conclude it.
Great. Thanks, Cam.
Hey, everyone. Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.